Gold is revered throughout history for its monetary worth and illustrious history, which has been entwined with cultures for millennia. Approximately 100 years earlier, during the reign of King Croesus of Lydia, the first pure gold coins were minted. This occurred approximately 650 BC. People have persisted to hoard gold for numerous reasons over the years. Societies and now economies have assigned value to gold, so sustaining its worth. It is the metal we use when other kinds of currencies fail. Thus, it always has value as an insurance policy against hard times. Investing in gold is one of the safest options to invest your money. Somehow, we always like the shiny stuff best. In this video, we'll be showing you 8 practical reasons to consider adding gold to your portfolio. We'll also be telling you 3 easy ways to start investing in gold. So keep watching. Welcome to another The Trend video. Today, we are going to talk about why you should invest in gold and how to do it. Before moving further, kindly like this video and subscribe to our channel so that you don't miss our upcoming amazing videos. So here are the 8 practical reasons to consider purchasing gold today. 8. A history of maintaining its worth. In contrast to paper currency, coins, and other assets, gold has retained its worth over time. People view gold as a way to preserve and pass on their wealth to future generations. People have revered the special features of the precious metal since ancient times. Gold does not corrode, and it can be melted over a standard flame, making it easy to manipulate and coin. In addition, unlike other elements, gold has a distinct, attractive hue. Einstein's theory of relativity was required to explain the phenomenon of light absorption by gold's heavier atoms and fast-moving electrons. 7. Vulnerability of the US dollar. Although the US dollar is among the country's most significant reserve currencies, when the dollar's value falls relative to other currencies, as it did in 1998 to 2008, consumers often seek the safety of gold, causing gold prices to rise. Between 1998 and 2008, the price of gold roughly tripled, pricing $1,000 per ounce in early 2008, and nearly doubling between 2008 and 2012, surpassing $2,000 per ounce. A number of factors contributed to the depreciation of the US dollar, including the country's enormous budget and trade deficits, and a substantial growth in the money supply. 6. Inflation hedge. Historically, gold has been a great hedge against inflation, as its price tends to increase when the cost of living rises. Throughout the past 50 years, investors have witnessed gold prices surge and the stock market fall amid periods of rising inflation. This is because when fiat currency loses purchasing power due to inflation, gold tends to be valued in those currency units and rises alongside other assets. In addition, gold is viewed as an excellent store of value. Thus, people may be urged to purchase gold when they perceive their local currency is depreciating. 5. Protection from deflation. Deflation is defined as a period in which prices fall, when business activity slows and the economy is burdened by excessive debt, which has not been seen globally since the Great Depression of the 1930s. Although a small amount of deflation occurred in some parts of the world after the 2008 financial crisis. During the Great Depression, gold's relative purchasing power increased while other prices plummeted. People decided to hoard cash, and the safest way to store cash at the time was in gold and gold coins. 4. Uncertainty in global affairs. Gold sustains its worth throughout both financial and geopolitical unpredictability. It is frequently referred to as the crisis commodity due to the fact that people run to its relative safety when global tensions mount. During such times, it frequently outperforms other assets. As a result of the Russian-Ukrainian crisis, for instance, gold prices have suffered significant price fluctuations this year. When confidence in governments is low, its price often climbs the highest. 3. Supply restrictions. Since the 1990s, the majority of the gold supply in the market has originated from the sales of gold bullion from the vaults of global central banks. In 2008, this selling by global central banks decreased significantly. In addition, the production of new gold from mines has decreased since 2000. According to bullionvault.com, annual gold production decreased from 2,573 metric tons in 2000 to 2,443 metric tons in 2007. According to the United States Geological Survey, gold production increased in 2011, reaching over 2,700 metric tons. It can take between 5 and 10 years to put a new mine into operation. In general, a decrease in gold supply causes a rise in gold prices. 2. Growing demand. In prior years, the rising prosperity of developing market economies enhanced the demand for gold. In many of these nations, gold is an integral part of the culture. In China, where gold bars are a common form of savings, the demand for gold has remained consistent. India is the second largest consumer of gold in the world. It is used for a variety of purposes, including jewelry. So the Indian wedding season in October is generally the time of year when global demand for gold is strongest. Investor demand for gold has also increased. Many are beginning to view commodities, especially gold, as an asset class in which to allocate capital. SPDR Gold Trust is one of the largest ETFs in the United States and the largest holder of gold bullion in the world as of 2022. 1. Diversification of portfolio. Finding investments that are not tightly associated is the key to diversification. Historically, gold has had a negative correlation with equities and other financial instruments. Recent events confirm this. The 1970s were prosperous for gold, but disastrous for stocks. The decades of the 1980s and the 1990s were prosperous for equities, but disastrous for gold. 2008 witnessed a significant decline in stocks as customers flocked to gold. In short, investors with a diversified portfolio use gold with stocks and bonds to lessen overall volatility and risk. Now we've told you 8 reasons why you should invest in gold. Now we've got to move on to telling you how to invest. Gold appeals to investors for a variety of reasons, and its characteristics make it a strong complement to standard investments, such as stocks and bonds. They view gold as a store of value, despite the fact that it is an asset that does not provide cash flow. Here are 3 distinctive ways to own gold for long-term gains. 3. Gold bullion. Buying gold in bars or coins is one of the most emotionally rewarding methods of ownership. You'll enjoy looking at it and touching it, but if you own more than a small amount, ownership comes with significant disadvantages as well. The necessity to secure and guarantee actual gold is one of the major disadvantages. For buyers of actual gold to generate a profit, the commodity's price must rise. This is in contrast to owners of a business, such as a gold mining firm, whose company can produce more gold and consequently more profit, resulting in a greater investment in that business. 2. Gold futures. You could even accept actual delivery of gold if you so desired, although physical delivery is not what motivates speculators. The enormous level of leverage available when investing in gold futures is the greatest benefit. In other words, you can acquire a substantial quantity of gold futures for a relatively modest cost. If gold futures move in the way you anticipate, you can quickly make a lot of money. 1. ETFs holding gold. If you don't want the inconvenience of owning actual gold or dealing with the rapid pace and margin requirements of the futures market, an exchange-traded fund, ETF, that follows the commodity is an excellent option. SPDR Gold Shares, iShares Gold Trust, and Aberdeen Standard Physical Gold Shares ETF are the 3 largest exchange-traded funds. The objective of these ETFs is to mimic the price performance of gold, minus the yearly expense ratio of the ETF. As of March 2022, the expense ratios for the funds shown above are merely 0.4%, 0.25%, and 0.17% respectively. The other major advantage of ETF ownership over bullion is that ETFs are more easily convertible into cash at the market price. Similar to selling a stock, the fund can be traded on any day the market is open, at the prevailing price. Therefore, gold ETFs are more liquid than real gold, and they may be traded from the convenience of your own home. The bottom line: gold should be a significant component of a diversified investment portfolio, due to the fact that its price rises in response to events that cause paper investments, such as stocks and bonds, to lose value. Although gold's price is subject to short-term volatility, it has always sustained its worth over the long run. It has functioned as a buffer against inflation and the degradation of major currencies over the years, making it a worthwhile investment. So what are your thoughts on this? Do you believe investing in gold is a good idea? When are you planning to make an investment in gold? Let us know in the comment section below. Thanks for watching this video. If you found it informative, do like and subscribe. And don't forget to give comments and provide us with your valuable feedback. Plus, if you want to suggest a topic for the next video, feel free to tell us. See you in the next video, and until then, stay tuned to the trend.